Welcome to the Tactical Brief and welcome to the Grey Market Talk, our latest edition with Thorsten Wegener, former market maker who still has to push the button occasionally, and Nick, former bond trader, chief investment officer, husband of 24 years. Congratulations on that again. And thank you for being here, Nick, on a very early Sunday morning. You have a golf tournament or something coming up?
No, we're having dinner in the Rheingau, or lunch, I should say, in the Rheingau with some friends later.
Oh, lovely. So excellent. We'll start with a couple of slides I came across during this week. And obviously, I'm always interested in your valued opinion about that. And you can see the screen, Nick?
Indeed, I can.
Yes. So the quite interesting slides for today. 3 sections. Thoughts from abroad, where we started last week. People actually seem to enjoy our take on Germany and what that means for the economy. If you don't live in a beautiful, expanding, business-like, accelerating country, then it's the economy, stupid. Let's look at some economic observations we made, and then we go into the greed and fear index, but not the CNN greed and fear index, something different. So, message of the week was actually Volkswagen. Their main cantina in Wolfsburg actually is serving currywurst again. What is currywurst? It's pork sausage with ketchup and curry, allegedly invented by a lady in Berlin. Berlin and Hamburg are fighting for the privilege. Who was the inventor of the currywurst, which is one of the German national dishes. Yeah, you have it with chips, or as the Americans say, French fries, and it's one of the highlights in every weekly lunch menu when you work in the corporate sector and you have a place to go to. Otherwise, you go to the little chippy around the corner and you get it as well. And there was a big scandal about that 1.5 years ago when they decided to go all vegan in one of their, food providing facilities at Volkswagen. And actually the politicians talked about that. They said, it's only at this one place and they want to go all vegetarian, vegan, and have alternatives, meatless alternatives. And the workers at the factory belt said, yeah, screw you. They went to the other places. So obviously the market forces are still working. Yeah, you have to attract people with the food you're offering. And I thought that gives us a little bit of hope for Germany to see this can come back. Which brings me to the main point. Now, this is our Chancellor, Mr. Scholz. It's official, we're run by fucking pirates in Germany. So this is not a meme, and actually, bless him, he posted it himself on Instagram. It was a running accident, not a bicycle accident like Mr. Biden had, falling off a standing bicycle, which happened to me the other week, by the way, as well. So, I don't know what that means for me. Anyway, so he fell over and concussed his eye, or you can actually see his scraps in his face. And I thought, yep, the memes are coming. And the way you're treating Germany at the moment, I think it's fair to say, officially, we're now in pirate territory. Why do I say that? A little bit of the more brutal numbers. This is the German budget for 24. And I thought it was very interesting. Last week, we were talking about the citizens' money, the Bürgergeld, which is going to be increased again. And the biggest budget post is obviously work and welfare. And there's also the pension number in here, which you can see. This is where the music plays in Germany. It's increasing by another 3.3%. Then defense is also increasing. It's actually quite funny. Nick, you remember how they went after Trump when he said Germany has to start pull its weight and we are too much exposed to Russian energy, and you had all these German politicians at the UN Vollversammlung snickering at him?
Yes, that's true. And it's good to see they're doing something.
Yeah, but that's one of these special Sondervermögen, which they called, how would you translate that actually, Sondervermögen?
Well, I don't know. I mean, I guess it's sort of off balance sheet, but I'm sure some of these
special wealth fund. Yeah, so it's just about the naming of it, which is nothing more or less than another 100 billion in debt. Yeah? And they simply call it different. So that should go into the Bundeswehr. Our magnificent army we have, after the former Secretary of Defense, Mrs. von der Leyen, who is now running the European Union, was very busy in equipping our armor with entrances or special ways for pregnant women to get in, and pregnancy uniforms, which is exactly what you want in a hot war. You want your pregnant women in those tanks to defend you because they're really aggressive, especially in the morning. That's the soldiers you want to have. So it's complete madness. Obviously, we can see here it's going on. The biggest investment increase in percentage is digital and traffic, because the traffic, public transport in Germany sucks the big one. The Deutsche Bahn is one of the worst run companies in the world. We're never on time anymore. If you use that, it's like a lottery game. And our communication with authorities in Germany is not the email, it's still the fax. That's the officially accepted form. I was asked the other day when I was getting a new passport to send something over. And I said, yeah, what's the email address? They said, no, you have to do that by fax. And I said, sorry, I left my fax in the 80s, 90s. That was the last time I used one. So, but apparently that is still a thing in Germany. And then you see what we are reducing. Interesting, health, minus 33%. That's obviously all the money that went out of Corona and is now not renewed until renewed again. I've seen the first guys with masks running around again. So it's making the rounds already. Some evil guys in the United States, obviously right-wingers, said they're preparing it for the next election again, the next panic that could come up. Then Wirtschaft und Klimaschutz, the economy and climate change. Why that has dropped, I don't know. Maybe they've already spent so much that it has to be reduced. And obviously Auswärtiges Amt, which are our diplomats, since Mrs. Baerbock is running a, how did she call it? A feminist foreign policy. That's her words, not mine. They don't need all that money. I don't really have an idea. Anyway, what we can see here, the budget is being reduced by 1.6%, which is, well, what you would expect, because the latest numbers came out again of all industrial nations. Germany is, well, tailgating. We are the last. We have negative growth in Germany, which makes you contemplate where this whole journey is eventually going. This week, the CEO of BMW gave an interview and said, no, this whole getting out of the exhaustion car business is a complete nightmare. We're going to lose jobs left, right, and center. And that gives me a little bit of hope that our industrial leaders, who were very much on the woke train for a long time, start realizing on which side their bread is buttered on. If you don't make money, you can't give yourself big bonuses anymore. And we'll have a little slide towards that coming up later. Focus on the US, but the same is true for Germany. And having seen all that, this is a nice statistics, also OECD, about how much taxes and insurances and welfare payments you make in Germany if you are single. So every euro you make, half of that is already going away in taxes and pension fund and unemployment insurance, and you name it. I think we spoke about that weeks ago when I said a couple of years ago I made this calculation for an article for the FAZ, which they didn't accept at the time, which showed after you pay the VAT on what you've left over and all the additional taxes, you are left with 20%. Yeah? So it's actually quite interesting. Slavery starts when you're being forced to work. Yeah? So we can't call that slavery. But if you're as a median income earner in Germany, 20% of what you produce through the value of your labor, you get up in the morning, you work hard, is only staying with you. How would you call that, Nick? Is there a definition for that?
20% is what's left, is your calculation.
That's really what your net cash that you have in your pocket to do something with it. Yeah, that's frivolous things like buying food or trying to be in a lit room, which is also not completely cold. Oh, so I had this conversation with the two, one gentleman and one lady in the local bakery, where I go every morning to get fresh rolls for my kids and get everything ready. And that was the Bild-Zeitung, the biggest German tabloid. And it simply says, Arbeit lohnt sich nicht mehr. It doesn't work to work anymore. But it's no point in it. And I had a conversation with these guys. And I said, how do you think about it? Obviously, I didn't spell it out, but if you are selling bread in the morning, it's not one of the high-paid jobs. It's in the medium to lower bracket in there. And one of these guys, bless his heart, actually is a young man, not a lad anymore, young man. He works in the bakery in the morning. So when I drop in there at 7 o'clock, they have already been there for 2 hours to get everything ready. And in the evening, I see him working for McDonald's. And I've asked him, oh, wow, that's a big schedule. How do you do that? He loves to go on a nice holiday once in a while with his wife, so he needs that extra money. And I thought to myself, wow, that is impressive, if you have this attitude. And I've asked him, I said, what do you think? Is it still worth working in Germany, especially after all the expenses I've just showed you, which is great. And I said, well, it gives me purpose, it gives me dignity, what I'm doing, work. And he said, I have a neighbor who's my age. He doesn't work at all, doesn't need to. Once in a while, he's making some extra money on the side. He used to be a tradesman, not paying taxes on that, having a nice life. And that is actually one of the things we also started discussing last week. What's the social cohesion for all of that? How long is that going to work? If these hardworking guys in the bakery in the morning are still doing their extra jobs to have a little bit of extra money, getting skimmed all the time, by a state which is taking huge amounts of tax in to spend on all sorts of programs, which leads me to this special person, that is Friedrich Merz. Friedrich Merz is the official leader of the opposition, of the CDU in Germany. And just after Nick and I went off air last Sunday, he had an interview in the FAZ, Frankfurter Allgemeine Zeitung, and he was totally agreeing with the lefty general secretary from the SPD, Mr. Klingbeil, that taxes in Germany are too low and that we should increase the highest tax rate for the well-off to be able to help the people who are less well-off. So, already our top tax bracket starts at 42 when you earn just above 60,000 euros annualized. And then there is the super wealth tax, which kicking in at 45. So he's actually, as the leader of the opposition, and they were called the conservatives in Germany. He is actually contemplating the idea, yes, we should have a higher tax rate to help the poor. Let's put it that way. Why is he doing that? He wants to be chancellor, desperately. He desperately wants to be chancellor one day, and he can only do that in a coalition government. So you can only do it with the Social Democrats or with the Greens. That's why for a long time now, he's deviated to the green side. Yeah, we all want to be carbon neutral, and it's fantastic, and also don't want to have nuclear power plants. And on the other side, obviously, we want to increase taxes again. So that's the state of the nation as I see it at the moment in Germany. I do not see any relief. Why is that interesting for a business podcast or an economics podcast, which is focusing on the macro? I've mentioned the elections are coming up in Bavaria and Hessen. And what we have to see is here, and that is getting interesting when we look about Capex a little bit later. When is the green project with carbon zero and moving away from fossil fuels into electricity, even though we can't provide it all, when is this experiment going to fail? And the elections will give us a very, very good idea what the man on the street thinks when his bills are going up, when she can't pay her transport anymore, when the taxes are being increased, because this will have real implications for, don't want to call it the fast movers, for the clever movers to actually build up positions in things which at the moment is a very crowded trade, the energy sector, but which on long term will be clearly a good investment case. Anything to add on the political side of this conversation, Nick?
Yeah, I mean, I think they all understand that they're all going to get voted back again, so they don't really need to do anything different to what they've been doing now. As you say, they want to be part of a coalition. They don't want to run the economy on their own. But all of them are missing like the big picture. And the big picture is there is a crisis. And this is not crisis management when the leader of an opposition comes up and says, well, actually, I've got a great idea. Let's increase rates from 42% to 47% or 46%, whatever it was, for the world to do in this economy. What's 46% of a smaller number? Because if the economy is in decline what does it all do? And this is where the problem lies. I mean, they can carry on this game for a while until extreme parties get a foothold in the economy. And that means that the politicians are blind to the big picture right now, in my view. They're all playing around the edges and they're missing the big story.
Yeah, it's like they're fiddling while Rome is burning. You really, all these old analogies seem to be working quite nicely. There is one of my favorite authors, Sebastian Haffner. He was a historian, lived in England during the Second World War, and is the ultimate, still quoted, having written the ultimate biography about Adolf Hitler. It's only 250 pages, but he was one of the prime intellectuals we had in Germany during the war and after the war. And he analyzed the situation and said people on the extremes, on the edges, only rise when society is in decline and falling. While Germany was doing well during the Weimar Republic, the golden 20 years, the Nazis had barely anybody voting for them. When the whole economy and the social construct started collapsing, suddenly they were collecting voters and voters and voters. So I see the danger with these morons not being able to actually attaching the problems, that they are making this whole situation worse. And I don't really know where this is going. If you read history like I love to do, it's a dangerous situation we are getting in, because all these guys seem to be so extremely average in their whole thought process, in their fantasy, in the guidance they have for us on the street. Anyway, let's go into the interesting bits, Nick. It's the economy, stupid. The most famous quote by Mr. Bill Clinton. He won the election against George Bush Sr., not the W, the old guy, with this slogan. I think that really turned it around at the time. And I was already old then, so I followed this election. I was a big Bill Clinton fan at the time because he really brought it to the point. I said, okay, how we're actually doing. And I came across a couple of slides. Most of you will have seen them because they went viral, but it's definitely worth discussing them. And one of these slides was this: Tesla many Model S and X prices tweaks. And these are the Tesla prices since the beginning of the year, start of the year for the Model S and the Model X, and where they are now. They've dropped by, well, roughly a quarter. Nick, what does that give us as a sign for the economy? If a luxury product, they are in the discretionary ETF, they are the big hyped, well, entrepreneur with a fantastic product. If you have to reduce your prices by 25%, how does that all work together? Is it China? Where's it coming from?
I think there are a couple of things here. I think this is a business decision, right? I mean, this is to get a foothold, a bigger foothold in the industry and to kill your competition. I mean, you know, if the German car makers look at that and they were beginning their production looking at 104,000 as a dollar price of the competition, and then some months later, a year later, they're looking at prices 25% lower. They've got to become more efficient. And if Tesla can make it at this price level, then so is the competition. China is, making big foothold in this. I mean, I know we talk about China economy being in such a bad state, but actually, when you look at the industry in China, and if the bad parts of China are the property sector, which unfortunately dwarfs everything else, but the industrial sector of China is booming, and the car industry is booming, and therefore you've got the car industry in China booming. You've got Tesla, who are putting pressure on the car industry through which is now moving in the direction of Tesla with electronic vehicles. This is going to be a very difficult story for the Europeans in this space.
You just mentioned industrial figures. Last week, I think industrial numbers for the US came out, and they sucked a big one as well, right? Below 50.
Yeah, this is, we understand that the industry is bad in the world, right? So it's except in China. I mean, industry in China, in Japan is doing really well. In Europe, it sucks. In America, it sucks. Service sector is growing in America. That's the thing keeping everything afloat. But, when we look at these numbers here, it really does tell you that there's even more pressure on the Europeans. And when German politicians, think the solution is by raising taxes by 3% and then everything should be fine, as I say, I think they're dreaming. And it's the economy is stupid. It was actually a James Carville quote. He was the advisor of Bill Clinton in 1992. And yeah, that did win the election. And that is really where every politician needs to focus right now. It's the economy. And if they don't focus on that, then, they will stagnate.
Well, there are more and more discussions actually at the moment in our circles about the social development. Can we, as a so-called capitalist society, which we are not, we're a corporate society as it looks like, can we survive this whole, if the rich are getting, I'm using now communist terms, if the rich are getting richer and the poor and the middle classes are waning away? I don't think we can. If the promise of that you can live better than your parents, and your parents, when they send you to a good school and pay all that money, that you will do better in life, if this promise is not there in society, and we were falling to the real right wing, not the fake, we call them right, but we're falling to the real nasty guys out there. And that's the big danger. On a micro level, you look at these Tesla numbers, Nick. If I look at the company, is that just he needs to get his aged models out, otherwise he's in trouble?
I must say, I don't analyze Tesla, and I wouldn't be able to judge why and what. But I'd look at the bigger picture here and say, if they're able to be profitable with these kinds of numbers, then that just goes to show that everyone else has got to be cut to the bone.
Yeah, well, that is a spectacular development if he can still make decent money and good revenue numbers, return on revenue, if he's able to drop prices by 25%. I'll have to have a closer look into that, because I said that before. I have a personal life insurance policy on Elon Musk, not with an insurance company, but with a very far out of the money digital spread on Tesla, just in case, long running. So let's see what will happen. Anyway, that brings me to one of the slides I got sent by one of our fans. We have fans now, Nick. It's a screenshot, as it looks like, from a television screen, and it shows the S&P 500 price earnings multiple versus 10-year real yield. What is real yield, Nick?
So yield is just yield is your return. So in this case, it will be talking about US Treasury bonds, right? So if you imagine 10-year Treasury bonds yield around 4.25% there or thereabouts, you take off inflation of, let's just say, your forward inflation expectations. Let's just say that's 2.25% or thereabouts. You take one from the other, you're effectively left with 2%, and that's what it's showing here is what is the actual return of treasuries after inflation, and comparing that with average earnings, and the reciprocal of earnings is effectively the yield, and the two track each other very well. You can see this from this chart. But since the middle of 22 or thereabouts, this relationship has gone adrift. And we understand
massively so, yeah.
Yeah, so we understand. And this is saying that, equity is rallying. Yeah, we know equity is rallying whilst the bond prices are falling. And this disconnect is the real question. Why do equities run whilst bonds fall? Yeah, it's making equities more expensive. It's making the net returns after treasury yields more expensive. It's making equities look certainly not cheap versus the alternative, which is bonds. And I think the story here is that there are many ways that you can actually kind of describe this thing, but the story is fundamentally people do not, they're not content with what's going on with sovereign debt. The finances of governments are just, the mathematics means that there will be some kind of sovereign debt blow up. And for that reason, they're running away from bonds as far as they can. And the only thing that they see is ultimately being protecting them is real assets. So, I mean, one asset here, which is a real asset, is equities. Go and buy some equities, get out of stocks. And this transition out of equities into, out of fixed income into equities is what we talked about when we said, okay, well, what is it that the Fed really need to do? They need to get real interest rates negative. Why? Because that's the only way that they can get tax revenue higher than the costs for an economy, and anything else would mean that the debts will just continue to explode and explode and explode, and sooner or later somebody's going to say, hang on a minute, surely we shouldn't be buying these things, what's the point? So for that reason, there'll be more people putting money into equities, and that's why you get this sort of this jaw between these two lines here. And how far it goes, who knows? But this is not sustainable for the US. Running real yields for the US Treasuries at 2% means that every year your budget deficit will continue to grow. Let's just say $1.5 trillion a year. Sooner or later, this compounding effect will just make these numbers so ridiculous that you've really got to question just how long they can keep this game going.
Now, when I was looking at this chart, I thought, okay, it's actually one of the explanations for me, which I think makes sense, is we're talking about here two asset classes which are caught in different, how would you describe, speeds? Yeah, the speed of the rate increase was so dramatic, which we've seen. We've never seen in history before. All the corporates who have to finance themselves, they are still loaded up with cheap money from the previous period. We spoke about this wall of debt, which will eventually come in at 24, 25, when they have to do the refinancing. So you have equities still benefiting from very low interest rates, where they took money out of the markets. They're still fine. They don't have to refinance yet. At the same time, interest rates in government bonds are producing nice yields again, which is a real alternative. What I've heard through my network in the States especially is that the new issue business seemed to be picking up again on the bond side. Yeah? New bond issues coming in the market. And one of the head scratchers for me was, yes, we have relatively high rates. And if everybody thinks, okay, we will see the Fed eventually pivoting, maybe not after Jackson Hole anymore, but eventually we'll see them pivoting when the economy goes into recession mode. Why do I have to do it now? Is it this, if you have to panic, Druckenmiller said it once, panic early. Is it these guys now saying, fine, as long as the credit market is not frozen up, which it eventually will, I'm going now into the refinancing cycle, and these jaws will eventually close the moment credit dries up. No matter where the interest rates then are, because we're getting into this tailspin, banks don't want to hand out money anymore. And what you can see here is actually the precursor of this inevitable narrowing of the alligator jaws by either equities are dropping or bond markets doing the unexpected.
Or both, yeah, absolutely. Yeah. They're both, they come together. I mean, but when you look at the PE multiple here, I'm assuming this is just of the broad S&P, right? And the broad S&P, as you know, is driven by a lot more of these FANG stocks. It's not really the debt heavy companies, so it's not to say that the apples of this world aren't really hurting today, but they will hurt later on for, when interest rates, when they have to refinance their debt. I think this is really, the one that's sort of mispriced here is not necessarily the equity. The one that's mispriced here is the bond. And the reason for that is purely and simply because of the, as you say, sticking the rates up, inflation, coming down. They haven't adjusted their rates. They'll be forced to do so because anything which keeps the interest rates and the real interest rates at such a high level for a sovereign which is so heavily indebted is just an absolute recipe for disaster. And for that reason, why would you want to be involved in fixed income until you see things turn?
Yeah, I think, well, when it happens, Alex Gurevich will be right. We'll see negative interest rates because, and you're right as well, because the sovereign will have to save itself at the cost of the saver out there. It's going to happen.
The point you made is right, that, the corporates aren't hurting at the moment, really, because, they refinanced, so they will refinance in 2024, 2025, 2026. And, that's the point where, they'll feel the pinch. And you look at the people who have bought homes and locked in their homes for 30 years, they don't have to refinance unless they move their homes because they can't transport their mortgage. So the only person who's really suffering from interest rate rises reasonably is the government. Yeah. It's like they're shooting themselves in the foot.
Yeah, well, I can see that here. Brings me to the next slide. We spoke about that, and that's a long time. You mentioned that a lot. Capex cycle. We have here technology sector versus the energy sector. The white line, which is at record levels, is Capex, capital spending for, well, the big tech sector. And what we can see here going down since, well, 2014. That's apparently when the whole woke green madness started. Going down to absolute lows. We're 71% from the 2014 peak here. What is the implication for that? And that's actually, let me make my answer first. That's why I started with politics as well, where I said, this is what we have to wait for. The political side of our societies will signal to us when the experiment will be counted as failed. We have one problem there. This zero carbon emission, we're going all green. Yes, if they come up with a magnificent invention and we have free energy without any pollution, fantastic. But then they will find another reason not to do it. But in a scenario like this, where the carbon producing industry has actually for the last 8 years not spent any money, I'm exaggerating here, and everybody was hoping for AI and high technology. If this experiment is failed, what is going to happen? I know I mentioned it, it's one of the most crowded trades. Everybody is on the long term bullish on energy. But if I look at this and say there are simple forces in nature, if you don't get this stuff out of the ground, people are not going to have it. And we have 8 billion people on the planet. They all want to sit in warmth. They all need energy. Am I saying that correctly, Nick? Or is there some special points to this chart?
Well, again, it's a chart, and everyone could have a look at it in their own way. But you're right. They've made an assessment. They say by 2050, zero carbon, please, and they're even pushing back today on carbon capture technologies. So the industry has come up and said, well, actually, we found reasonable ways to actually capture the carbon and stick it underground, and therefore we can continue and maybe manage the transition a little bit easier to a carbon neutral world. But there is a lot of pushback for that. So it's clear that the political will is that the fossil fuels actually go. And this chart explains why it's very difficult for fossil fuel companies to continue to provide any kind of spare capacity, because there's been, according to this chart, very little investment in the industry, over the last years. And if you want, I mean, the thing, I had a discussion with a client about a month ago, and I said, well, if you want to protect yourself from inflation long term, what are the things that you can do? And so we talked about gold, and we talked about all of this stuff. And the other thing I mentioned was energy. So energy is something in your portfolio that will protect you from inflation at the end of the day. And, not having energy in your portfolio, this is why it's potentially a crowded trade, because I think everybody's got the message that, down the road, it is highly likely, with all of this debt that's in place right now, that the governments will just overwhelm the economy, and there will be higher inflation. We talk about sort of deglobalization right now, and that's more likely to push prices higher. So how do you protect yourself longer term? And that is to have energy in your portfolio for your pension, in your pension, with all of the other things that you have to now think about, because, governments have frankly cocked it up.
It's always this, how Biden said, think about what you think about. What I find interesting, and there is actually a socialist playbook out there. If that happens, when that happens, after socialist policies, they will nationalize energy. Yeah, then you'll have all the Shell executives who came out and said, oh, yeah, we want to be a zero carbon carbon company will eventually get the horse shut from underneath their bottoms, because that is usually what happens in socialist societies. Ooh, people can't put their light on. We have rolling blackouts. Obviously, it must be the evil capitalists who are still making money. Let's nationalize it.
Well, the point I made in our discussion on BRICS was that if the BRICS control, let's just say, around 50% of oil production, and if they start to tweak their production, which happened afterwards, then they effectively control inflation at the West. They control interest rates of the West. They control, investments in the West, returns in the West. They are the people with the power, because at least for now, whilst oil is a required substance for the transition, then the BRICS actually have, and they yield a great deal of power, and this should not be underestimated.
Yeah, no, I'm with you. So next slide. Former colleague from Bear Stearns, Jesse Felder, put that out. And I thought it was very interesting. What are we seeing in front of us? The Magnificent Seven. He went in and aggregated their free cash flows of all these companies and simply put out a ratio to the average price they're having, going back to 2012. And I thought that was very intriguing. You see that we are far away from the average. Everybody knows that they're highly valuated, obviously. Oh, by the way, I heard a nice rumor. Is NVIDIA the next Wirecard? Did you come across that?
No, that's only you who could come across something like this.
Oh, it's from the dark places of YouTube. And what I found interesting about this, obviously, there are a couple of not crackpots, but professional traders who are now saying, okay, there are some subsidies which actually got borrowed money from NVIDIA and then bought their chips, but they actually are owned by NVIDIA. You go into the details in YouTube yourself, you will find that. What I found interesting about this, obviously we are old enough. We know Enron and we know WorldCom, and we've heard about Wirecard, which was the recent scandal. So I'm not so much worried about that actually there's any gravity to it, which could always be. But what immediately popped through my mind, what is if somebody like Hindenburg Research is coming out with a big paper, which is putting the innuendo out that there is something, because how that usually works, these companies don't really respond or are suing them, because then there would be a thing, especially in the United States, which is called discovery. They would have to submit their data. That would then let, for the defense, Hindenburg Research or whoever of the short sellers out there, have a look into their numbers. So that's why you can't really defend yourself against it. But if these rumors start slowly, and they started slowly with Wirecard, they started slowly with Enron, they started slowly with WorldCom, that could actually be an additional risk, talking about NVIDIA now, where you say, well, do I have to really be long and see the hope for the price target, which most of the analysts, gives me the segue to the next slide, that is from Bloomberg here, how the analysts are being positioned out of the coverage of 63 analysts, 59 have buy ratings on NVIDIA. And the target price on average is $638 in this company. So all analysts are already bullish, besides the 4 guys who want to make themselves a name, or who probably have started the rumors to be the heroes and then get a contract for $5 million a year as the analyst who caught it in advance. Why should I now think, okay, it's still on a run and I can make an additional 50% out of this stock, when everybody there is already bullish? We've seen that before, Nick, haven't we?
Yeah, right. But, this, if I look at Amazon here, is 64 and 61. And the people who are not bullish, they may just be neutral. Yeah. I mean, it doesn't mean that they're bearish necessarily, but, going back to the previous slide of Jesse Felder, I mean, all of these names, right? We know they're expensive. Okay. So we know how these bull markets start. They start full of promise. And then you have to see what happens 5 years' time, right? You never know what's going to happen with these companies. And certainly you don't want to play against the trend. And, I'm a momentum and trend guy. Okay. So that means that even if something is above this red line, I would still be recommending to buy this stuff if the momentum and the trend makes, sense. If the chart effectively says the rally will continue. I know nothing about what's inside these companies. I certainly don't have the resources to analyze, but momentum and trend is still in favor of one or all or whatever of these companies here. You are in until the time has come to get out. And very rarely you have a stock which sort of is 100 one day and is 0 the next. And there's normally enough time to sort of say, oh, the momentum is drying up here, or the trend is starting to reverse here. And then you can get out. And that's, one thing that I would say about all of these Magnificent Seven is that you're in until you're out. And whether it's sort of, you could have said they were expensive at 40 or at 45 on this chart, or 50s, it's now almost 60, whatever that means, versus free cash flow. I mean, these are just numbers, but the trend is still in favor. And, why do we have this trend? And it comes back to, or people are scared of, where is the alternative? And the alternative is government bonds. And they're saying, well, actually, I used to have my money there. It didn't really help me. So for the last 3 years, I've lost money by being in fixed income. So I will stick my money into something which is moving. And this is all we're seeing today. It doesn't mean that these companies are really, truly worth this amount of money. And if they are worth this amount of money, then if you weren't in, you've missed the opportunity. And the return probably from all of these companies for the next 10 years will be negligible, right? The trade is gone. And you have to understand, when you do these, when you look at things like this, over a 10-year time horizon, you're looking to make your 7, 8, 9%. And I remember once saying to you, what if that 7, 8, 9% per annum is all PV'd in year 1, 2, or 3? And it may well be that the whole PV of NVIDIA is going to be made in the next year or two. And for the next 10 years, it does absolutely nothing other than be a great company. You have to sort of be involved when the time is to be involved, not necessarily to fight the trends. I mean, that's how I would, advise or recommend, or whatever you want to call it. I don't fight trends. I go with them.
No, I agree with you on that. One of the early, maybe you could call it very early indicators I like to look at is, especially if you have a volatility-wise very subdued general market, which we have at the moment again, and you see realized volatilities in these shares with high volume going up. That is when I'm always start getting curious why that is. Yeah? Why is realized volatility? And we've seen it recently in Apple. We've seen it now in NVIDIA picking up. Maybe that's just normal wobbles we see in the market all the time. But it's definitely something where I think, okay, it deserves a little bit more attention. Otherwise, I totally agree with you. Well, one of the oldest adages, don't fight the trend. Yeah, if the market is going one direction, there are plenty of opportunities to still get out when it confirms. You never hit the high or the low in markets. And so I think we are in agreement here, which brings me to the point with Nick. I wanted to ask you, are you an average investor?
No idea. I have no idea how to measure this thing. I have no idea how people actually.
Everybody who's just listening, I've just put a JP Morgan asset management chart up here where you see 20-year analyzed returns by asset classes. And REITs had the best returns, probably related to that a lot of them don't have real markets, private equity. Then emerging markets equity with 10%. At the bottom is cash with 1.2%. And the interesting thing, the S&P 500 over the last 20 years had 9.5% annualized. Over longer term, that's 7 point something. And the average investor here is with 3.6. I was looking through the small print, how they define the average investor. I couldn't find anything, what that actually means. But I thought it was very interesting. You see the 60-40 portfolio is at this long-term 7.4%. The S&P is delivering 60% equities, 40% bonds, probably not over the last 12 months, but in general, I thought, okay, the average investor, is that just everybody who's running around on Wall Street? Or have they just picked, I don't know, some retail dudes? Because I know a lot of retail dudes who beat every hedge fund for years now out of the water.
Yeah, I mean, it's an interesting chart, and for historians, it's all I can say. I tend to look at what's going to happen next. What is the chart looking like in the future? And there's certain bits in here where we know that there is a lot of investment today, and that's in the 60-40 or 40-60, whatever you want to call it. Cash is no longer yielding 1.2%. Commodities here. We talked about potentially there is scope. Inflation. Look, inflation here, 2.2%. Okay. Question mark there. REITs, where are they going? Emerging has struggled of late, I must say. So different time horizons show different results here. I'm more interested in the future, and I would say this table has been dramatically shaken up in the last 3 years now, and in particular because of what's happened with the bond markets, right?
You know what's totally missing here? We had a private discussion about that. It's obviously not something we can cover in this scope. Volatility as an asset class and the various shenanigans you can do with it. That is something we are privately on a business side are focusing on at the moment. But no, I thought it was just one of the fun bits, which gets me finally to the greed and fear part. And this time I have not used the CNN Fear and Greed Index, but this slide went around, the highest paid CEOs in the United States, which kicks in again with this, what's the social cohesion? Yeah, how does that actually work? And I thought it was very interesting. You have companies here from Blackstone, Google, Hertz, Peloton. The others are too small. I can't really see it. Oracle, Pinterest, and Apple. And you have the CEOs in here with their pay packages. And everybody of these 10 is, obviously that's why they're the highest paid, above, no, Tim Cook is just short of 100 million a year. And I was interested, who's actually a founder of these companies? Who is the guy who set it up and is coining it big time now, which would be my excuse to say, hey, well, without you, there would be no company. Fine, help yourself. It's your baby. You took the risk. You had the vision. You got it out. So we could say Schwarzman from BlackRock is in here. And probably the guy from Peloton, Barry McCarthy, if it's still the original founder who's CEO. I haven't researched that. I apologize for that. But the rest are all managers. How can managers make 100 million a year in a company like, let's pick one, Peloton, who almost went or is, I don't know, I don't want to libel them. I proposed to my students, when was that, 2 years ago, to set up a short in Peloton, which we took for just 2 short. When I got the first emails suddenly telling me your Peloton bike would have a discount of 25%. Before that, they had adverts during the Corona heights. You could get a $5, and I'm not exaggerating, $5 or $10 off a $2,500 product. And suddenly they were dropping the price by 25%. And I thought, guys, this is not a good sign. In one of the overhyped companies. And that's why this 25% stuck in my head, bringing us back to the Tesla slide. Yeah, suddenly 25% off a product, allegedly everybody wants to have. So looking at these numbers, managers making 100 million. Yes, you might be the best manager in the world, but then you have to sell it. You have to sell it to society. You have to sell it to your middle management. You have to sell it to the employees on the ground who are helping you in the production cycle. And I think if you look at this, then also it doesn't bear well for the future of our society, what people might think about that. Brings me to the next point, and then we are finishing off here. The real greed and fear index, what we see in front of us, the VIX now. VIX again at 13. At 13, we did a nice trade where we bought it the last time when it was 13 and skipped out after 50% to the upside, which happened. And now we, well, imploded again is the right word. And I heard a nice quote years and years and years ago when I've asked, it was a seasoned derivatives trader, and I said, so what's your opinion on equity markets? We are fairly highly valued now here. And he said, when volatility is below 15, nothing bad happens. Obviously, that doesn't mean if we go above 15, then we could increase very fast. But at the moment, we are again in this scenario which is closing the circle. We have an extremely subdued market in terms of volatility, and we see realized volatility, that what really happens under high volume picking up in some of these magnificent sevens. Definitely something where you want to have your warning signs going on. And when I talk about the VIX, obviously the VIX also has a VIX. The volatility of the VIX is also at very, very low levels, which means options on protection are relatively cheap at the moment. Because the purview in the market, or the preview of the market, is now it's all good, all is fine. We were not going to see a crash. We're optimistic. The fear and greed index of CNN showed a neutral reading at 50. But this actually shows you what people who vote with their real money are thinking. And the real money at the moment thinks, nothing to see here. Just chill. All good. Nothing's going to happen. We'll get a soft landing. There will be only a minor recession. Everything is beautiful. And let's go along. Let's buy those nasty equities and become a millionaire overnight. I found that interesting. And the last slide is the skew index. The skew index simply gives you an overview how aggressive people are buying out of the money protection. If the skew index is high, then they're paying more for puts, and if it's low, they're paying low for puts. Nick and I had the conversation earlier. I said, is that a leading indicator? And I said, I wish, and things would be so much easier. It's more a coincident indicator, but out of my experience looking at this thing, what you always can see is that, and I now call it the smart money. The smart money is willing to pay just before the proverbial hits the fan, paying more for outside protection, even especially when it's very cheap. It's getting in relative terms a little bit more expensive. And while the market then is taking a dive, they start not renewing or even selling their increased positions. And at the moment, we are again at a level where, with a big candle here, it's on a weekly basis, is telling me maybe the smart money thinks, yeah, let's use the opportunities of very low prices for tail insurance and set that up a little bit. Yes, I don't get it at the cheapest level anymore. That was when Torsten told us to buy, but I'm still at a good position here to build that up. If then the proverbial seasonality increase in volatility comes, which should be expected for, well, the third, fourth week of September, because that's what we apparently see in September, and the market is now playing a complete correlation with seasonalities, that would be an appropriate time to consider tail hedge protection here, because what the market tells me at the moment on the volatility side, people are bullish. People are extremely bullish. You don't need protection. You don't buy an insurance if you think your house will burn down. You save that money and spend it on, I don't know, luxury goods to improve your house when you think everything will be fine for the future. And we know out of experience, that's usually not what happens. So these were my final words on what was going on in this week and what's likely for the future. Nick, famous last words from your side, and I stop sharing. What are your thoughts?
I thought that was fascinating, your last slide, I must say. I used to watch the skew because I thought I managed to find a way to get skew divided by, I can't remember what factor I used, but as being more of a leading indicator. So I think I've been lazy, or at least I've sort of ignored it for too long. And so it's now on my radar. Thanks very much.
Thank you for your time. I hope you'll have a wonderful day, and I hope you will join us again next week when we see what was happening in the market, whether Germany is doing something more stupid. Prices for luxury goods are further dropping in the United States, and volatility is either the bottom is falling out or my call might make sense. As I said, it's never a recommendation we're giving here. It's just for entertainment purposes. Thank you very much, Nick. See you next week. Thank you very much for watching. Bye-bye.
See you. Bye-bye.